Hello, everybody, and welcome to this week's Middle Class Investor. This is Seth Martin. Thank you for coming in this week and watching the videos. Well, what we have on the screen here is the 10-year Treasury yield. And oddly enough, this is the week that I've really started hearing kind of the mainstream media really talking about it. And I think it's finally starting to catch some of the financial people's eyes on the market, because they're seeing some pretty strong moves in this market. And we've been talking about this for a while. So just to recap quickly, as yields go up, or maybe a better way to say it is, as bond prices go down, yields go up. So what happens is countries borrow money. In this case, the United States wants to borrow money. It does so through its bond market, and it's got several bond markets. We have a 20-year bond market, a 30-year bond market, a 10-year bond market. We have a 7-year bond market. We have a 5, and we have 2s, and we also have 3-month, and really short-term markets. Anyway, the most important of these markets is the 10-year Treasury. The reason is it's what all your mortgages are based on. It's what your car loans are based on. This market is considered to be the benchmark for deciding whether or not you're going to get those interest-free loans on cars, or whether your mortgage rate's going to be 4.5 or 6.5. That's where all this is calculated from, is the 10-year Treasury. So it is the most important interest rate probably in the world. So it's a very important market, and I've been stressing it for a while, and I'm stressing it today, but I can't stress enough how important this market is. And the fact that interest rates have been going down now for 30 plus years. There's roughly a 30-year cycle. So we're in the very, very, very beginning stages of a change in that cycle. Actually, the beginning of the stage appears to be the start of that was back in here in mid 2012. So what we've been saying is that if this is the first move up and this is the first pullback, this move here is going to be very, very substantial. There's ways to estimate it. Probably the best way to estimate it is using something called Fibonacci retracement, except we're going to do, instead of retracement, we're going to do extension. So you just basically come to the most recent high, and you pull back to the low, and you look for this 1.618, which is right here. So we're talking about this move going from 2.476, where it is today, to 4.05 or something like that, 4.05. So notice it's right in the place where this last swing was, and so that makes a lot of sense. Now, sometimes too, another thing you can do is you can wait till it what we call breaks out. So once it breaks above this high, then you can go from this high back to this low and do a retracement and look for about a 2.0. And there's nothing magic about these numbers. They just happen over and over again. So a 2.0 is up here around 4.4%. So somewhere between 4.05 and 4.4% is where this is likely to go and pause, or stop and turn and pull back. So and I can just tell you that move is probably going to happen pretty rapidly. And you're talking about, that's probably a 30 to 40% drop in bond prices. So if you have bond funds, you're going to lose a lot of money in this move. So I don't want to beat a dead horse, but that's an important message that I'm trying to deliver as part of this YouTube channel. And even if you don't even if your friends and family are not interested in watching these weekly videos, which I can understand. I mean, most people are not interested in this. Please, please, please talk to them about how they should not be in bond funds. By the time they actually hear about this, will have already lost a lot of money. So make sure you try to talk to your friends and family members, your loved ones, and caution them about being in this in their bond funds, in their 401k and IRAs. All right, so hopefully that's clear enough. I don't want to go too far and be obnoxious. So hopefully that's clear enough. All right, the S&P 500. We're gonna talk a little bit about the S&P 500, but then I'm going to switch to the Wilshire, and then we're going to look at the NASDAQ and the Russell real quick, because what's happened is that in the Dow and the S&P, you don't have a new high. Okay, we didn't have a new high. We had a down week, but you can see from the graph here, or from the chart, that this didn't make a new high. So it would have had to have gotten up over this area right here, and I don't know what this number is right off the top of my head, but it's higher than 2133. It's probably like 2135 or 2138, something like that. So the S&P 500 would have had to get up over that to make a new high, and so I'm not sure again what that makes of the pattern that has developed, but as you can see here, the way I've sketched it out, I was expecting this to move up to above this 2133 area, somewhere along this the upper channel, and then roll over. So we still could get a new high. I mean, it's possible that the market, the market kind of does something like, I mean, it's already pulling back. It could pull back a little further, let's say into this, I mean, very little further into this area, and then make its way up to here like this. And then if it does, that will have completed this ending diagonal or rising wedge pattern. And the nature of this pattern is that it goes back to the start. It starts right here. So you're around 1800. Now, let me go back and zoom in, because there's a possibility here that let's draw in a scenario or so here. Let's say we pull back to this line, and then it makes its way up, and then doesn't even take out this high and starts to roll over. Well, then as soon as we're out of this trend line here and this channel here, then this formation should kind of start going to fruition. Now, what will it do? It's probably not going to go just straight down like this. It'd probably come to maybe this area, like a support area off of this low here. So we might get something into this area, and then have it kind of zigzag its way back up to just underneath the trend line, and then come down. So, but what we're going to be very keen on is what is happening in and around this area, around 2120 to 2130. I mean, is it going to continue up and make a new high, or is it going to roll over here? Because if it comes in and rolls over here and breaks out of this pattern, this bull market's probably over. That doesn't mean you have to get out right away. It just means that you should expect kind of more focus on this and getting ready to make a decision that might have you stepping to the sidelines. So let me just show you real quick the NASDAQ, and you can see here the NASDAQ made a new high. I put the old high kind of around this line here, and you can see that we actually made a new high. And sorry about that, not adjusting that correctly. Made a new high and then quickly reversed. So this is pretty common when you get up to new high areas. You can see this all the time in just regular kind of traveling parts of the market. Market tends to move just past new highs, and then at least pull back and rest. So, I mean, I'm not saying this is for sure over, but even when you have a breakout, even a regular breakout, usually you would get a close above this line. So you would get, you would have gotten a candle, let's say, that looks more like that. And then you could get a pullback to below the line, and then it continues on. But usually you get a close when it pops up like this. You usually get a close above the pop-up line, and we did not get that in the NASDAQ. And pretty sure we didn't get in the Russell either. Yeah, see the same thing in the Russell here. Let's move that just a tad to right there. So, because I didn't have the last one drawn properly. Let me zoom in a little bit more. And then zoom in with this. There we go. Get that just right. There we go. So you can see here we actually did have a close above on the Russell, but then it came up and kind of tucked itself back in. So these markets are, they're very, very extended here. I mean, they could go a little higher. I'd say with the S&P and the Dow going lower and the transports going lower, that's probably not a high probability scenario. But the reality is we just don't know. So we can talk about what if, and if it does this and if it does that. That's legitimate, but it's not proper to say that we know that it's going to roll over here or something like that. So it's okay to take a position, if you think it's going to roll over. That position could be a short position. It could be I take my money out of the stock market. It could be there's a whole bunch of things you could do. But we have to recognize that we really don't know what the direction of the market is. The direction as it appears right now is bullish, but we've got all-time highs in some of the markets. We got the Dow transports diverging. We got the Dow and S&P not making new highs with this with the Russell and the NASDAQ. We got the Wilshire did make new highs. The Wilshire's 5,000 stocks. So it did make a new high, albeit very, very slight. Sometimes that guy Deneric that I mentioned last week, sometimes people use the Wilshire because it's more diverse. It's a more diverse market. There's more stocks in it, and it's more indicative. They're kind of focused on what they call social mood and trying to chart social mood. And so the more stocks you have in an index, the more likely you're going to have a proper chart for social mood. But we'll continue to watch the Wilshire too. But certainly the markets are showing a little bit of weakness. The market is very thin right now. There's a lot of what's the word? When you start looking at the various industries and sectors, really the financials have kind of been up. You can see here's the XLF, so that's pretty much an uptrend. The biotechs, which are like, I'm not even sure what that is. Amgen, for example. See, Amgen is bullish. BIIB, which is Biogen. These are up. But really, other than financials and the biotechs, and then some of your big monster stocks like Apple, your techs like Google, these are up or sideways. But there's a lot of stocks that are down. I mean, look at Micron. Micron came out with earnings today, and I mean, look at this move, 18%. I mean, that's a huge move down. And usually, technology sector, things like chips, like Intel and stuff like that, they really lead. So you got kind of a head and shoulders forming here on Intel. So if you got Intel, if Intel breaks kind of this area right here, you're looking at Intel's going to be probably going to go down to this area here. So a $10 loss in Intel. If you start looking at individual stocks, you'll find probably more than half are in bear markets, maybe as many as 2/3. And then you've got a narrowing and an ever narrowing. Nike is up today on earnings. You got kind of an ever narrowing market of stocks that are still in bull markets. Now, having said that, regardless of what the market's doing, there's about 75% of the stocks follow the market. So if the market is going up, about 75% of the stocks are going up. If the market's going down, then about 75% of the stocks are going down. So you can always find stocks moving opposite the direction of the market. But generally speaking, as investors, we want to be aligned with stocks that are in the direction of the market trend. So that's getting off on a little bit of a tangent, but I did want to let you know that the market is weakening in a number of really key areas, and that usually starts giving you a sign. So what tends to happen is one by one these industries get weaker and weaker and weaker, and then the market gets weaker and starts to roll over and go down. That's kind of how that works. Let's look at the euro US dollar. So, with Greece still going on and all that mess over there, who knows what's going to happen with the euro? It looks like the market is market's preparing for the euro to make a new low. I would say that's perfectly logical given what's going on over there right now. Let's look at Germany. Germany's still hanging on this trend line, but looking weak, and also this looks somewhat corrective. It's sometimes hard to tell here at the end, but you get this, you got kind of a channel here. Notice when the market moves in a direction in a large channel, that's usually corrective. In other words, if I draw this line, if I draw a line down through this way on this downtrend, and kind of down through this way, see how you have this excursion outside the channel? That's usually impulsive. So, you can draw it a bunch of different ways, and maybe, it's just hard to tell. There's not enough movement here to really tell. Here's another one. You can see this looks pretty corrective all the way up, really. So, anyway, we'll just wait and see how Germany looks. Japan, Japan was in this sideways trend forever, and it finally broke out. And Japan, still looks like it wants to get up here and, get into this area where resistance is. Japan is destroying its currency. So we've talked about this before. So anytime your currency gets weaker, the stocks denominated in that currency appear to be stronger. But if you were to look at this chart and divide it by inflation, like whatever their PPI is, you would actually either see this not going up or potentially even going down, depending on how much inflation they're actually experiencing as a country. The UK still is struggling in this area. We've been looking at this area for quite a while now, and to me it looks like it's about done. I would expect the UK to move down somewhere into this direction. The key to know, to really kind of be sure, not that you're sure, but to wait and take a trade, you might wait for a close below this low right here, and then that should signal the end of the little uptrend here for the UK, and the next move should be down into this area somewhere down here. Let's see, what have we not talked about? Volatility, there's not much going on in volatility. It's pretty quiet, but we do have this scenario kind of brewing. This week we had a huge range in volatility. but you could see, you can tell that it's closed in the top of its range. And if the market rolls over and starts to sell off because bonds are really selling off and interest rates are really going up, you're going to see volatility move out of this area pretty rapidly. So, and then once volatility gets above a certain point, it tends to hang around for a while. So, just be aware of that. There's nothing to be afraid of or anything like that. Just be aware of it. Let's see, the U.S. dollar. There's been a lot of talk about the dollar this week as well, which is interesting because you hadn't heard a whole lot about the dollar in years, except to explain why we need to weaken it so that exporters could export more goods and services. But if you look at the dollar, I mean, it's looking pretty much like it's through going down here. And if we analyze this a little bit more carefully, and of course I've got these lines on here to kind of obscure some of this, but you can see that the low, you can see you kind of had this correction right here, right? I've got it drawn on there. And you can see the low was pretty much right here. So this looks like this was our first move out. We've corrected back into this area, and now the dollar looks like it's on its way to higher prices. So if that does happen, I'd say if you get the dollar breaking out above, let's say above this area right here, if you get the dollar breaking out above this area right here, which is 97.5, stocks are definitely going to roll over because people are really fearful about this dollar trade, and if it really takes out and goes, I mean, it might pause here at this resistance area, but it's likely to go straight through it and probably visit these. We're talking about a while here too. We're talking about a long time. It's taking a while, but we're probably talking about it, maybe not getting up to the old highs, but, getting into this area right here around 108 or so. We can look at gold. Gold is really struggling with looking at gold right now. It's hanging on to this support area. It popped up above this. We've spent a lot of time talking about this, and I've talked about how to get into this trade and talked about this would be a decent entry right here, and then we've done nothing but kind of trade sideways around that entry. So if you did get into gold there, you may be down a little bit, and you certainly haven't made any money. So that's turning out not to be a good entry. But sometimes the markets will do this. Sometimes they'll just chop around and hang around before they take out. And I wish this had taken out already because with the dollar where it is and poised to take off, I'm kind of leaning toward gold maybe going down from here. So I would have thought the dollar would have pulled back a little longer and given gold time to get up into this area and then pull back. So, but it doesn't look like that's going to happen. I don't know for sure. Gold is still really oversold right here. I mean, you can see this long average right here. I mean, you would expect gold to come up and at least get somewhere near this this longer term moving average here, but it's just not happening. So right now the picture is not very clear in gold, and so I don't have a whole lot to add to that. We can go look at the DAX. I know some of us out there like to look at the DAX. The DAX, again, if this is, even the trading program here doesn't have this going to new highs. This signal here just takes you to this area here. So Ninja Trader is talking about this going to a DP off of this swing right here. So you might see the DAX get up into this 12,000 area, 12,100 area, maybe zigzag its way up there. But it's possible that the DAX is at the very beginning of making a downtrend. The only way to know is once you get into this area is, will the market make a new high or not? I mean, let's say it zigzags its way up here and goes through this old high back here. There's an old high. If it goes through that, then we know. But if it kind of stops here at the decision point and turns around, then you can probably stick a nail in the coffin of the DAX. Crude oil, it's kind of hanging around. It's funny, I drew this line a while back. And it's just been hanging around this line. I'm expecting crude oil to get up into this wave 4, but it might not. It might sell off from here and then try to make it up into that wave 4 area. So crude oil is I don't know, it's hard to see anything right now. It makes sense that it's kind of paused because the dollar's kind of paused for a while, but just not really seeing what's there on the dollar. I mean, on the crude oil chart. This is bonds. This is 30-year Treasury. You can see they've been down, kind of made a double top, and have been falling. We're probably going to get some sort of rebound in the bonds. Maybe not. I mean, it's not for sure, but the bonds could be in the middle of we've been talking about it in the Treasury. If this is the first move down and this is the first correction, then this is let's just see if it pulls up here. Probably show it as a wave 3. Yeah, see, typical wave 3 is down here, and it could go further than that. That's just the typical. You got all these other locations on here, extended and maximum. So, I mean, they may not stop here. They may just keep on trucking. So that's why it's so critical that you get out of bond funds and either into something else or put that money in cash and save it until we've got something else to put it into. I've got the YM, which is the Dow, and you can see here the high was on the 20th. That's why I have this chart up, is to show you that the high was on the 20th. And we could get, if we get, this is kind of setting up to be corrective looking, but if we get something that looks like this and starts to turn here, then we're not going to get a new high probably, unless it does something like that. But my point is, if we get a, let me make this point a little bit better. If we get something, let's say we come up here like this, and I'm going to draw a candle. Let's say the candle looks like this, and then we get another candle that looks like this with the close below this one, then this is likely to be a corrective motion or corrective pattern, and we're looking at something like that. So believe me, I'm going to keep a very close eye on it, and we'll let you know. Same thing in the S&P 500. This is the ES, which is the S&P 500 E-mini futures. Same thing. The high was on the 20th. We have this down move. We've got this kind of corrective looking thing going on right now. We'll probably get some sort of movement up this direction. If it makes it to the new high, great. If it doesn't and starts to roll over, then we'll take action accordingly. That is really about it. I can't think of anything else we need to talk about. We'll just watch the markets closely. We'll let you know what we see. We're probably going to bring the Wilshire 5000 into our analysis just because, Deneric's using it, and it did make a new high. And it's a pretty broad index. I mean, 5,000 stocks covers a lot of territory. So we'll probably go ahead and use that. Make sure you tell people about Middle Class Investor. Here's the YouTube site. Change it up a little bit, make it a little easier to find the videos and see which one's the most recent and so on and so forth. You can subscribe. Once you click on this, it'll bring up a panel. It'll show you share. You can share it. You can subscribe. Now, to do that, you actually have to go create a YouTube channel. Or not a YouTube channel, but you have to create a YouTube account. So, but do that and forward it to friends and family members. Tell them about bonds. It's so stressful to be in these huge turns. These are huge. These are not corrections. The timing of these particular turns that I'm talking about are not just corrections. These are large, multi-generational, multi-decade type corrections. I won't go into how I know that. I mean, there's a whole study on that. It takes a lot of effort and energy to study on that. But suffice it to say, these are not just 10% or 15% or even 20% pullbacks in the market. These are major corrections, deflationary type scenarios that will impact everybody. I don't care if you're rich. It doesn't even matter if you're Warren Buffett. You got $70 billion. 10 years from now, you're going to have $30 billion. That's just the way it's going to be. So now $30 billion is still a lot of money, right? But my point is, who wants to lose $40 billion? Well, I don't know, but that's probably what's going to happen. So anyway, that's it. If anybody's got any questions or comments, please feel free to comment, and the email will come to me, and I can answer you, or if it doesn't require an answer, I'll just read it. But anyway, that's it for the week, everybody. Thanks a lot for coming in, and we'll see you next time. Take care. Bye-bye.